This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
Please, speak as you might to a young child or a golden retriever.
Rich get richer, that's the law of the land.
I owe you nothing.
It's just money.
This is madness.
Everybody just yells and screams at each other. Nobody's civil anymore.
That's not the kind of humor we do on this show.
Put that coffee down.
I drink your milkshake.
Now you're looking for the secret.
There can be only one.
Everything becomes chaos.
Can you dig it?
All right, everybody, welcome to Milkshakes Markets Madness. My name is John Kutzmita. I'm joined today, as always, with Brent Johnson. Now, we discuss, obviously, financial markets. The madness piece of our name has to do mostly with the craziness that goes on in Twitter, but financial markets are a bit maddening themselves. And the milkshake piece, if you don't know what that is referencing, you'll have to go to our website milkshakespod.com. And in the About Us section, we kind of explain that. Brent, welcome back for another week of madness.
Here we are. What is this? The second or third week of the year? I can't even remember.
This is season 1. The first 5 episodes we kind of treated as season 0. So we're now episode 3 of season 1. So
There we go.
We're on a roll here. So we did want to, in the conception of the show, have a bit of a markets-based theme, but also a bit of, I guess you could say, coffee talk. And not everybody is a sports fan, but you and I are. And last week we kind of skipped over. We had the college football national championship. Some people know, some people don't, that you're a former college athlete. So I know that that level of competition does mean something to you. Did you watch the game, and do you have any kind of thoughts on what it was like being a college athlete?
Yeah, unfortunately, it was like the most boring national championship game I can remember. Unfortunately, it was, and I had like high hopes for it. One of my it was a TCU, which is kind of I don't know. I guess they've always been okay, but only in the last, I don't know, let's say 5 years they've gotten pretty good, and then they were very good this year, and they were taking on Georgia, who is the the reigning national champ of the SEC, which in my opinion is far and away the best football conference. And so, but I had some high hopes that TCU might be able to give them a good match, but it was just it was a track meet from the get-go, and I fell asleep in the second half and woke up and the game was over.
That's never a good thing.
So that was a little disappointing, but college football is my favorite sport. I love it. I think it's great, and got to wait 9 more months before season starts again.
Yeah, controversially on that topic, at least from my standpoint, I can never get into the college football thing. It just feels like it's the only sport where people are so hyped and focused on the junior league, right? We don't really follow the the B leagues and anything else, whether it's baseball. No one follows minor league baseball, and hockey. The farm teams are almost like an excuse to just go drink beer at an ice rink.
Sure. Well, I think for me, growing up in a little town in Nebraska where literally football is almost a religion. And we didn't have a pro team. Denver was 4 hours away, so a lot of people like the Broncos, and then Kansas City was 8 hours away, so a lot of people like the Chiefs. But those were our closest pro teams, so everybody just grew up, wearing red all the time and cheering for the Cornhuskers. And so, I just naturally became a college football fan by osmosis as much as anything.
Do you think there's the aspects of I played sports as almost as long as I could walk. All through high school. I didn't get involved at the college level, but do you think there's things that you took from that experience that are part of your trading disciplines?
Oh, no doubt. No doubt. I had two coaches. My basketball coach in high school had a huge impact on me, and then my basketball coach in college had a huge impact on me. And when my coach in high school, his famous saying was, never be satisfied. So no matter how well you did, or no matter it doesn't mean you can't improve. It doesn't mean you don't keep working hard. And then my college coach, he is probably the most intense person and competitive person I've ever met in my life. And he had this amazing way of knocking me down to about 1 inch tall, and at the same time lifting me up in the same sentence. And so, it was fantastic. And his favorite saying at the time was, he said he'd go to war with passing game and man-to-man defense. So if he could take on anybody in the world if he just taught his team how to play man-to-man defense and a passing game offense. Didn't matter what the other team would do. If you do those two things well, you'll be okay. And so it sounds silly, but I always remember that, and I put that into my business. Man-to-man defense, I'm always thinking about how do we protect, right? And then offense, you just pass and you cut away. You pass and you cut away, and you're always looking for that opportunity. And so it sounds silly and it sounds a little cliche, but I'm never satisfied, and I'm always looking at the downside, and I'm always looking at how to make money. So I think of that stuff all the time.
Backtracking to the college championship game, I don't know. Did you get or catch wind or see the? There's an audio clip floating around from the Georgia coach's basically pregame speech. Did you see that or hear that?
I didn't see it. No, I didn't see it.
I'm going to find it and stick it in the. I know this is slightly off topic for some of the people who are more market driven, but I think mindset and the mentality as you try to tackle something as competitive and as complex as the financial markets, you need systems and you kind of need some of that discipline, but you also need a bit of you got to get fired up to get into the trenches. So sometimes it's, you can relate these things to other fields or professions, and sports just happens to be one. Obviously you and I have a connection with, but yeah, I'll put the audio in there. It's just good, man. He gets those guys fired up.
I definitely want to see. I will tell you just a little anecdote. So I grew up in Nebraska, again, like I said, where football's religion, and a good friend of mine, he grew up in Georgia, where it's probably pretty similar. Now, when I was in high school or in college, Nebraska won back-to-back national championships, and now Georgia's won back-to-back national championships. And when I went to my friend's wedding in Georgia, that's probably 15, 20 years ago now. The best man gave up to give the best man speech and spoke 20 minutes about Georgia's recruiting class for that fall's football team. So everybody was enthralled with what he had to say. So that's the level of football madness in Georgia.
Yeah, it is a bit of madness. Well, speaking of madness and markets, it was not to bang the same drum, but the BOJ in Japan has been such a topical theme at the start of this year, but no one really kind of, speaking of, a track meet, it's been a bit of a foot race neck and neck to an extent of how is this market going to start out? Who's going to set the pace? And now we're starting to see it. Do you want to add some thoughts on, certainly it's been a little bit more red for equities. Bond markets are starting to finally get a bid. Where do you see some of this going now that, the colors are starting to come a little more clear?
Well, what's pretty interesting is there was a chart going around either yesterday or today. I'll see if I can find it. It was Darren LaCal sent it out, and it was basically showing how last year was the worst year since 1987 or whatever. Well, the first 2 weeks of this year for risk markets for equities was the best 2 weeks since 1987. Now that changed a little bit over the last 2 days. Equities kind of peaked on Wednesday and have sold off. They sold off fairly hard into the afternoon yesterday, and so they were down 1%, 1.5% today or something. I am of the belief that we are headed towards a risk-off event. I think it will be in the second. I think we talked about this maybe a couple episodes of. My base case is that by the end of the second quarter, if not before then, we're going to revisit the lows in equities and probably go lower than that. Yesterday, I was looking at some charts and we kind of ran up right against this downward sloping resistance line. We had the VIX under 19, so it was 1850. I actually bought some puts. I actually sent out a tweet saying, that I thought equities would go red, and I got lucky on that one, and they did. I just think you have to be careful here. the risk that I see is that everybody else thinks there's going to be a recession as well. So that's my risk, is trying to figure out how that could be wrong. But I think equity markets have probably peaked for the very short term. I think they're due to pull back a little bit. I think things got a little bit ahead of themselves in the first 2 weeks of the year. 2 days ago, or is it yesterday now? The bank, like you mentioned, the Bank of Japan had their meeting. It was like the most anticipated central bank meeting in a very long time that wasn't a Fed meeting. My thing with Japan and the yield curve control, and for anybody that's just tuning into this episode, we've talked a lot about Japan over the last 3 or 4 or 5 episodes, and it's because it's super important. They have threatened, for lack of a better word, to expand the yield curve band. And I don't think that they will do it. I don't think that they can. And if they do abandon the yield curve band, or if they widen the band, I think they will have to reverse that decision in very short order. Now, I'm not saying it's impossible. Of course, it's possible. But the yen has strengthened a lot since October. I think it's up 15%, 10 or 15% since October. That's a pretty big move for a currency. It was down like 25% last year, on the way down, and now it's rebounded. And I don't think it goes much. I don't think it gets much stronger from here, if at all. If it does, I think it's short-lived. At the end of the day, a government can save either the currency or the bonds, and I think that they will end up sacrificing the yen.
All right, lots to unpack there. So, a previous episode, you had called attention to the put-call ratio and this notion that everybody was bearish. This was like the most projected, forecasted recession. It seemed like, I guess, to some extent from that ratio that people were putting their money behind their mouth. And maybe the first 2 weeks was really just a short squeeze. And now we're seeing some of that kind of work through the market. But in regards to the BOJ and Japan, can you give some context on why, and not just right now, but just in general, why the Japanese yen has mattered so much as kind of like a forward leading indicator, or kind of an economic or pre-recessionary indicator?
Well, part of the reason that the yen is important is it's a funding currency, and people use the yen for a carry trade. And so, if you're not super, I guess, sophisticated with financial lingo, and you hear that, you're like, what the hell is a carry trade? What does that mean, right? We'll try to put it down into like a normal person's language, and it basically means you borrow in yen because interest rates have always been, next to zero or even negative in Japan. So you can borrow the currency very cheaply. You don't have to pay a lot to borrow it. And then you can go invest that somewhere else. And so global investors have sold yen. So they've shorted yen or borrowed yen and then gone and bought, US bonds or European bonds or US equities or emerging market stocks or whatever it is. So global investors, including Japanese investors, have borrowed in yen and then gone and invested it all over the world. And the reason they've done that is, part of it is that the interest rate have been really low. And so since the interest rates are low, the currency has remained fairly low. And it hasn't gotten super strong. And so, and especially last year, it fell a lot. So that even encouraged more people to borrow, because if you borrow when the yen's 120 and it goes to 140, now you pay it, you can pay back less in US dollar terms. What happens though is if the Bank of Japan lets the interest rate widen, the yield curve control band widen, that means now interest rates could go to 50 basis points, which they have, or to 1%, or to 1.5%, which doesn't sound like a lot until you realize it's 3 or 4 times how much it is right now, right? And so if you're a carry trader and you are borrowing that yen, and then all of a sudden it starts to, not only does the currency start to strengthen against your home currency, but now the interest cost to short it costs more. The cost of funding of your carry trade is going up, and it could go up significantly if the currency were to appreciate significantly. So what that does is it's kind of like a short squeeze on the yen. So then people buy back the yen or close out that borrow, and then that can have an effect of pushing the price up as well. What that can also do, though, is then that if you're paying off your funding, then you have to sell whatever you bought when you borrowed. Remember I said you borrow and then you go buy emerging market stocks, or you go buy US bonds, or you go buy European bonds. Well, now if you have to close out that yen short position, you have to sell whatever you bought in order to go pay off that yen or to send that money back to Japan. And so that has the potential to be very risk off, or that has the potential to be very disruptive or to spike volatility in global markets. So about the most risk off I can think of is if we got a short squeeze on the yen or an unwind of this carry trade, and the yen strengthens versus the dollar, but the dollar strengthens because of the chaos that this causes. The dollar strengthens versus all other currencies. In other words, if you get the dollar and the yen rallying together versus all other currencies, to me that is a very bad sign for global markets. And so that is why the Bank of Japan meeting and what they do is so important.
Yeah, great explanation. I appreciate that. So when we're looking at that, contextually speaking, so you had given a reference of 120 to 140. So 120 to $1 US for anyone who wasn't tracking on that. And to make that carry trade a little clearer, just, we'll look at it as a more easy number to follow. If you borrow and the yen is 100 to 1, and then suddenly it goes from 101 to 120, now you've got to think about how that impacts you on the other side. But as these trades kind of unwind, or people are selling assets and going back into the yen, closing out their position, buying that yen back, that's going to make the yen appreciate, as you just said. And assuming people are selling everything that isn't the US dollar, or kind of that cleanest dirty shirt, you could have that situation where both the yen and the US dollar are going up, which basically is a flashing warning that people are getting out of the riskiest of risk, and there could be domino effects to that. If that's the case, and this is somewhat of the role that the yen plays, and therefore the impact that the BOJ can have with various monetary policy, it seems very, very almost careless that they would, without an announcement, right? They kind of came out of nowhere in mid-December and said, hey, guess what, everybody, we're widening the band. Like, it almost seems like they're trying to take some shots at the market, knowing that this is what goes on, that people are playing these carry trades with the yen. It seems a bit of a dangerous move, wouldn't you say?
Yeah, I mean, to me, again, maybe they will actually do it. I don't think that they will do it. And if they do it, I think they will regret doing it. But I think it's a bluff. I think they're jawboning the market. I mean, the yen got really, really weak last year. I mean, it went from like 115 at the beginning of the year all the way to 150 at one point. And now it's come all the way back to 130. At one point, I think it was at the end of September. Yes, at the end of September, they were both increasing yield curve control, and they were out there intervening in the yen market in order to stabilize the yen. So in other words, they want the yen to go down, but they don't want it to collapse. Nobody wants hyperinflation. Nobody wants a collapsing currency, right? But I think they know that it's going to have to weaken. And I don't, and you've seen the similar things from the European Central Bank, and you see the Fed do it all the time. Central bankers like to jawbone the market. Them just saying something can have the market move, right? And I think if they know that they're going to have to increase yield curve control and do more of it, the only way to keep the currency from just collapsing is to jawbone it, right? If you can't actually widen the band, and you can't actually, stop yield curve control, then your other option is to bluff. And the thing is, central bankers are very powerful. If they say we're going to intervene in the yen market and we're going to make it go higher, in the short term, they can do it. They can make things happen in the short term. And if you're short $1 billion of yen and the BOJ comes out and says, you know what, maybe we will, widen the band, or maybe we will intervene and strengthen the yen, you're $1 billion short. And by the way, if you ever hear anybody saying I'm a yard short, a yard is $1 billion. So if you hear this financial lingo and somebody says a yard, that's $1 billion. That's just a little lingo for you. So if you're short a yard of yen and the Bank of Japan comes out and says, maybe we will widen this band and you'll get a higher interest rate on your yen, that's going to cause some people some sleepless nights, right? So you've got to have a pretty big stack to be able to take on the Bank of Japan. Now, I think they're bluffing. I don't think that they can actually do it. But, it is a poker game. So, we'll see if they have the cards.
It's interesting. We always talk about, or certainly you do, the idea that if you had the power that they have, if you had the printing press, the notion that you would do things differently or that you wouldn't abuse that power, certainly you wouldn't willingly give it up. It's similar to this ability to jawbone and move markets just by, saying something. It's these central bankers are almost like social media influencers. It's like a Trump tweet or Kanye West.
They absolutely are. That's actually a very good analogy. I might have to steal that one, John.
Okay.
It's a very good analogy. They're financial market influencers. That's exactly what they are.
So you'd also, 40,000 foot view on some of this. We dive a little deeper. You're mentioning things we've mentioned before, maybe not unpacked enough. Do you want to explain a little more granularity, the idea that you can't save the currency and the bond market, that, you got to choose one?
Okay, so the way I'll explain it, and I'm going to do it in very simplified terms, and I'm sure there's going to be somebody out there that says, that's not technically exactly the way it works. So granted, okay, I'm going to try to keep this very simple. But essentially, the way that you save the bond market, in other words, if interest rates rise so high that you can no longer afford to service the debt, and they rise really high because nobody else is buying your debt or your bonds, then you have to go buy them. The central bank has to go buy them to keep those interest rates low and to make sure that the treasury auctions function. Okay. So where does the government get the money to go buy those bonds? Right? They print it, quote unquote, print it. Now, I'm not going to get into the whole, do central banks actually print money or not, but for this argument, let's just say they print it, right? And so, when they do that, they are increasing the supply of yen, because that yen didn't exist a minute ago, but now they go buy $120 billion worth of bonds. That money had to come from somewhere, and the central banks conjure it out of thin air to do it. Okay, so now they're increasing the potential supply of yen, or the supply of yen, and so then that puts downward pressure on the yen. Well, what do you do to, so then you get into the situation where the currency starts to get in trouble, which is exactly what was happening last year with the yen. Okay, so how do they strengthen the yen? Well, they say, we're going to let interest rates go higher. What happens when interest rates go higher? Bond prices go down. So, the point is and you can do them both for a little bit, and you can kind of influence them both, but at some point, you have to choose, do I want to save the currency and have the bond markets keep going down, which I would say they're not going to do, or do you want to sacrifice the currency and let the bond markets stay strong? And so, unfortunately, they're just at cross purposes. And, it's like driving a car with your foot on the brakes and the gas. It can be done, and it can work for maybe a block or two, but you're not going to drive from, New York to LA with your foot on the gas and the brakes. It's just not going to work. The car is going to break down at some point. And I think that's what we've got going on in Japan right now. Well,
and can you, in maybe a quick sentence or two, explain why the bonds are what they ultimately choose to save?
Yeah, essentially, the bonds are how governments fund themselves, right? If nobody buys the government bonds, then the government is not going to be able to get any money. Then they would literally just have to print it, right? Literally just print physical yen. And so, if the bonds, if nobody shows up at treasury auctions, then governments can't fund themselves, and the government can't fund themselves, then the government collapses. And I promise you, no matter how altruistic you think your government is, they care about themselves more than they care about you. I'm sorry, that's just the way it is. If they are always going to try to preserve themselves. And they'll say, we're preserving the government for the greater good. If we weren't here, we would have this lawless, craziness, and, we'd have Armageddon, and, it'd be like the Night of the Living Dead and the Purge and all this kind of stuff. So, the government sees themselves as necessary. And so they will always sacrifice an individual for the greater good of the government.
Well, Brent, you and I are here for the greater good. This was a good learning episode. I appreciate you throwing some knowledge down on the table. If you guys are new to the show, there's definitely a lot more that we've shared in previous episodes that unpack some of these ideas. I encourage you to go back. Otherwise, we look forward, to having you join us in the future, and we'll do a lot more explaining and learning in those future episodes. But you can find us on milkshakespod.com or any social media, including YouTube at milkshakespod. We appreciate the interaction. What ultimately drives a lot of the conversation and themes each week are the comments and feedback we get. We are keeping a tally of those things. So sometimes in the effort to keep these episodes somewhat within a 30-minute time frame, we might not get to it immediately, but our goal is certainly to address questions and anyone who's providing some topical feedback. So
we've actually got a couple of questions already keyed up, and we're probably at some point, maybe we'll just do a whole episode full of Q&A. But so if you've sent in a question we haven't answered it yet, please keep sending them in. We got them, and we're going to get to them.
Excellent. So again, I'm John Kutsmita. This is Brent Johnson. We're Milkshakes Markets Madness. We can't wait to see you next week. Thank you. See you, Brent.
Bye, guys.
Hey,